What kind of life insurance, what kind of insurance do you need as a young couple who's just gotten together? So you made a big decision. You're going to share your expenses. Two can live for as little as one, which isn't really true. It does cost more. Your food's going to go up, and you might need more space. And life is expensive here in Nova Scotia. It's gotten a lot more expensive since COVID, hasn't it? And let's say this is a young, sort of professional couple bringing home net around $8,500 a month. Pretty good, isn't it? Sounds like quite a bit of money. But in Halifax, HRM, you're probably going to have to pay about $2,500 a month for a fairly modest apartment. Not a palace, but a fairly modest apartment. Maybe you can get away with $2,100 or something. You're going to have to pay some utilities, and you should have apartment insurance to cover your contents. Plus, you're going to have at least one car, probably two cars, if you're each going to different locations to work. And let's say you're a teacher, so you're going to two different schools. So perhaps you can use public transportation. That would help a lot. So maybe get it along with one car. And cars are very expensive. No matter how you do it, you have the capital cost of buying a car. Maybe the best thing is to buy a 2 or 3 year old car early in your life together when you're building your dreams. But you're still going to have to consider a couple $1,000s a year for maintenance and insurance and that. Probably a little more than that. You're going to have to pay for food, probably $1,500 a month. You're young, you want to be going places, you want to go have a date night, you maybe take a little vacation every year, nothing too crazy. You're trying to be frugal, you want to save. So I've made some assumptions here, and everybody's different, of course, but might want to buy a house in the next 4 or 5 years. Perhaps you want to start a family in the next 5-6 years. Today you don't have any children, you're together, but you're going to have responsibilities. And now you have a partner and you're spending more than what you were when you were by yourselves. So you want to protect your partner. We buy insurance for people we love and people we owe money to. So how much life insurance should you get and what type? Now, this is a financial planning diagram. Most planners and that use this kind of scenario. So you start at the beginning, you're building security. Hopefully you have some health insurance through your group plan at work. You have a small amount of life insurance. Teachers in Nova Scotia have $50,000 of life insurance, which is nothing. You'll need some tenants insurance. You'll need an emergency fund. You'll want to have at least 6 months saved up in case of emergencies. Now, when you've gotten together and you don't have much, maybe you allocate a credit card to this. This is not good. I mean, it's 22% interest or something. But if you don't have it, you don't have it. But you need something. So if something happens to you and you're suddenly out of work, find a good job again. You don't have to be so stressed about it. And then we move more into personal savings, maybe acquiring a home, getting your own home. So if you want to buy a house, I would use a first home buyer savings plan that you get a tax deduction for, and the money you save up and the return on that money is tax-free, and you can use it for your down payment. You're allowed $16,000, it might be $16,500 per year, and each of you could do that. Although I would say you'll be hard pressed to save more than $1,200, $1,500 a month. I would say you are a very good saver if you are saving that much per month, and congrats on that. And when you go to buy your house, you're going to face having to make a down payment, which first-time home buyer, you're probably going to be going in at 5%. And you're going to have to hire a lawyer. In Halifax, you're going to have to pay deed-transfer tax, which is 1.5% off the purchase price. You are going to want a home inspection. you're going to have to hire a mover or spend money to move your apartment contents to your home. You'll probably need to buy a little bit of furniture. Addition, watch out. Now, a lot of stuff you can buy on Marketplace or whatever. It doesn't really matter. Something like a dining room set. What's the difference? If it's good, and you probably only pay about 30 cents on the dollar for it. But you're going to have expenses. So I said $42,000 for the down payment and the closing expenses, plus the move and everything. You're going to have your food, you're going to have all those things you had before, you're going to have some car expenses and everything. Try to save, I would say most reasonably, unless you're really, really frugal, it's going to take you 3 to 5 years to get ready to buy your home. And when you buy it in Halifax for a townhouse like this, you're probably looking at HRM, you're probably looking at $500,000 plus, probably more like $550,000. You're looking at a mortgage if you're paying around 4% in the area of towards around $3,000 a month, plus or minus. And you're going to have to pay property tax on that, which is typically about $1.40 per $100 of value, so 1.4% of the value of the house, and it will probably be, I don't think it'll be appraised right for the purchase price, but it will be probably appraised at $450 or something. So you're going to be looking at about $6,000 to $7,000 a year. So let's say $500 extra for taxes. You're going to have to heat your home, your electric's going up, you need a little money for maintenance. Your housing cost has gone from maybe $2,500 up to approaching towards $4,000 with insurance and everything. Pretty hefty bill. And maybe there are children in the horizon. So anyway, getting back to the starting period, I recommend that you buy term life insurance and you figure you could get a 6% return on a balanced kind of portfolio over time, and you should figure that inflation would be 2% plus. So what you could do is take your income. Let's say 80% of it is needed by your partner. God forbid, if you didn't wake up some morning or you had an accident or something. You would need around $1 million to replace that 80% of your net income. Often that will be done on gross. So that's even $1 million. That sounds like a lot of life insurance, but really isn't today. You might even want to be more in the area of 1.4, 1.5. So if you met with me as your insurance advisor, we would go through those numbers and we would make sure that you're covered. And I suggest as soon as possible you get that term insurance. It's cheap, so you've got it. You can convert it later to a permanent solution, but this would be typically for a 20-year renewable term. And at the end of 20 years, it's going to go up a lot. You're now in your 50s, and that's where health issues really occur in life. $55, $60 a month would give you a joint, what we call first to die policy for the two of you for $1 million. It might be wise to have individual policies. That would bring you up more towards $75, $80 a month, really. The difference isn't that much, and I would recommend it. You could add $50,000 each of critical illness coverage. Cost you probably around about $12 a month, and this typically covers the 20 most common critical illnesses that people suffer from, and that would give you $50,000 of money if that should occur with you, and you would be paying about $12, $13 a month at your young age. You would need to look at your disability coverage between now and when you retire. Your probability of having a long-term disability is about 40% from what the disability insurers. It's a big risk. And as a couple, your probability is high. Now, the average period is about 3 years, and I always recommend you have a good emergency fund so you can wait four months or something before you start receiving benefits to keep your premiums low. And we have to look at it. Now, if you have group insurance, this is largely looked after, depending on your income level, what you do, because usually there's a limit. I think the teachers in Nova Scotia have a limit of about $6,100 per month. So you need your at least 6 months. So I would suggest maybe a year to work towards having this kind of saving. It's going to be hard for you to save money when you first buy this house, and especially when you start having children. After a while, try to start again getting back into monthly savings. Get that emergency fund built up, start investing. So we start with covering our risk. That's insurance. And with your home, as you build up equity in your house, I would suggest you have a homeowner's equity line of credit that could step in as an emergency fund for you. And then start saving $500,000 a month going into your TFSA. By the time you get to be 45, 50, you're going to want to look at converting some of that term insurance to permanent insurance. It's going to cost you a fair bit more per thousand, but it's going to cover you for your lifetime. In the value of life, when the Twin Towers came down and they had the commission on the value of life, I think it was 20 times the yearly income they decided was the value of a human life. I mean, we're all different, but this is a financial thing. And I'm an insurance advisor. I've been in business for many years. I owned many different types of business. I did a lot of business analysis and help with people analyzing their future and that. People always don't like to buy insurance. They don't like to buy house insurance, car insurance. But we know we have to. And it's the same with life insurance and disability insurance. These are real risks that we need to cover. And I'm here to help you with that. And it's up to you to decide how much, when. But I recommend that as early as you can, get a lot of term insurance. And this will be convertible. It will protect your insurability. So should your blood pressure go up or some other issue that you have that means you can't buy life insurance, but you want to have a house, you want to have children, buy the term insurance early. Just get going on it. And then as you get older and finances ease up, then we can talk about permanent insurance. Or one of the people I work with, I may not be here to talk with you, but we have in my team that I work with, we have CPA, trust officers, investment people, and other life insurance people to advise you. Consider this. Remember, we buy the stuff for the people we love and the stuff that we owe money on and that we want to protect. We protect our home, our cars, our other assets. But most of all, it's all based around your income. Focus on that. And remember, security, saving, investing. I hope you found this helpful and gave you some numbers that you can think about. You have a great day. This is Burton Langell. I live here in Nova Scotia. And in the description, you'll find a link that you can book an appointment and we can have a chat, no obligation. My focus is on what is best for you and giving you advice, and it's up to you as to what you wish to do. You have a great day. Thank you.